Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Wednesday, December 14th, and then we'll see how things are looking for Thursday, December 15th. We started out pretty positive, but we had the big FOMC announcement. They did end up raising rates 0.5% or 50 basis points, but the market really decided to be negative after that happened. And they didn't really get the messages from Chairperson Powell that they were expecting. So what had been an improving environment is now back to more negative, but could be improving. And that's what we see a lot when we're in a trendless environment. We have a good up day, maybe one or two up days, things are turning more positive. Then we have a down day or one or two down days, things are turning back more negative because our indicators are just bouncing around. Since we're not really trending and we've been going sideways overall, we get shot into some kind of a bias, either a positive bias or a negative bias. And that's pretty much where we're at right now. So let's go back and talk about what happened. Right at the open, we had a higher open. Seemed like things were looking a little bit more upbeat. Prices advanced above the daily pivot at 40.38. As the day went on, and this is very common, after the opening gyration that usually occurs, prices tend to settle down and trade within a range. This was a little wider range than usual. Usually it's pretty subdued with a slight upward bias. Well, in Wednesday's session, we bounced between 40.50, that was the upside before the announcement, and the daily pivot. And so there wasn't a lot of action really going on. After the announcement came, prices then fell. They pretty much took on a negative tone immediately and then stayed that way for the rest of the day. I have a 1-minute intraday chart to show you. So prices fell down to S1 at 39.75. So we lost that 4,000 level. We were actually above the 200-day moving average earlier in the session, but then we gave that back. And then we bounced for the rest of the day a bit above S1, and we closed just slightly above S1. Going into the close, we were down 0.61%, and volume was still above average. So we're seeing a slight pickup in volume. Our technicals, as I said, we're kind of mixed right now, but we're trendless. And so it's really hard to get a good handle on, are we going to shoot higher? Are we going to shoot lower? We were hoping that maybe Wednesday's session would clear up some things. And if you watched yesterday's video, I said that only three things can happen. We go up from here, we go down, or we stay about the same. The most frustrating one being that we stay about the same, and that's kind of where we're at right now. And that's usually the one that, at least in this kind of an environment, it's usually what happens, and that leaves us more gray than any kind of black and white. But the markets are still really fixated on this inflation and interest rate scenario, and will be for the foreseeable future. Here's the intraday chart where we had a positive open here. We went up. It was pretty much flat, but then we went up. We were able to get above the daily pivot, and then the daily pivot acted as support with the 40.50 level acting as resistance. Then the announcement was made. We immediately shot down. There was a lot of gyrating going on all over the place, and we ended up closing a little bit above S1. And here's the 1-minute chart where we had been more positive leading up to the announcement, and then things just tanked. We went all the way back down. That's where we hit the low. Tried to stage a bit of a comeback, but then that quickly faded as well. So it was a real roller coaster, choppy day overall. So what are some comments that we can make? Before the announcement, stocks were positive and then went negative after the announcement. It was hoped that the Fed would be more dovish, and I'm going to kind of paraphrase what was said and some information that came out. The median estimate for the terminal rate, that's where the Fed will top out and just let them stay at that level, and then hopefully at some point start to lower interest rates. Well, the last time we got this reading, we were at 4.6% for the terminal rate, for the median terminal rate. Now that's bumped up all the way to 5.10%. So that's a lot higher than what the market had been anticipating. So that's more negative. And then Chairperson Powell said that there's a need to get inflation back down to 2%. Okay, that's been what the Fed has been trying to do all along. They've had this 2% idea going all the time, but they need to have more evidence to see that inflation is actually falling and staying down. So it continues to decline, not just some reading that we get that looks really good, and then in the context of the bigger picture, it kind of fooled everybody. They need to see sustained downward path. And this next part also suggests that they're going to continue with what they've been saying, that once they get to this terminal rate, whatever that is, right now it looks like it could be 5 to 5.10%. They're going to sit there for some time and let interest rates stay at these levels. And there's also really no cuts that are being planned. That's more of a dovish Fed that the stock market really likes. And they didn't really get any of that out of Wednesday's session. So they turned a lot more negative. The US dollar declined. It's really been having trouble lately, where for most of 2022, the dollar has just been screaming higher and higher and higher. Now we're starting to see that continued weakness come into the dollar, and interest rates fell. The VIX was down on a down day, and I do have a chart to show you of that. And small caps continue to underperform. We like to see small caps outperforming or at least matching what the S&P is doing, and that gives us more of a positive environment. We're not seeing that right now. We still have all of our yield curves that are inverted, and this is just suggesting economic weakness going forward and possibly a recession, even though a lot of folks say we've been in a recession already. But other folks say the employment situation is too positive right now. That's not really what we call a recession. Sentiment continues to be positive. It really hasn't moved all that much. You've got a lot of folks that, okay, we're going up and they turn more positive. We're going down and they get a little bit more negative. They're chopping around as well in this trendless environment. The economic reports that came out, every week we get the MBA mortgage applications index, and that fell. Or excuse me, it came in at 3.2%, where last time it fell 1.9%. To buy a new house or purchase applications, they were up 4%, and refinancing applications were up 3%. So we're seeing a little bit of growth in that area, which overall has been seeing some weakness. Import prices were down 0.6%. The last time they were down 0.4%. And then if you take out oil, they were down 0.4%, and the last time they were down 0.1%. So that's actually a little bit more favorable when you have prices falling. Export prices also declined 0.3%. The last time they were down 0.4%. If you take out agriculture, they were down 0.6%, where the last time we got this, it was down 0.3%. Our trend is still positive. The green line's on top, even though it's declining. So that's kind of throwing some confusion into our charts right now. And it is getting a bit stronger. We're trying to come back above that moving average, but we haven't quite crossed that yet. We're still below 20. So that's more the line in the sand for that we're in a trendless environment. With the down day, I've changed our bias to negative, and I've kept our momentum at mixed because we had some pretty good up days and then a down day. We're kind of going back and forth with our overall stance on things. Here's the chart that I've been showing a lot lately, and it's updated as of last Friday. That is the green area. When you compare or you look at the 2006 through 2008, we saw a lot of weakness going in. At least it would match up to go into the end of the year on this chart. Is the S&P going to do that? Or are we going to be able to break what we see happening in this model and actually go to the upside? It's undecided at this point. Here's the VIX, which still is at a pretty low level right now. And if it really starts to spike up, that usually means that stocks are going down, and the VIX could get to a very high level before that decline finishes. But we don't really know if that's going to happen yet or not. Here's the VIX, where it actually declined on a down day. That's kind of strange. Usually on a down day, the VIX will go up. I don't have any equity put call ratio charts They didn't update. Usually they're updated by the time I go through and look at all the charts, but they didn't update this time. So the fact that the VIX declined on a down day is kind of strange. And here's just showing how the small caps continue to underperform the S&P 500. In a good, solid environment, we would want to see this go higher, and with the blue line crossing above the red line, which it has done. So it was showing some improvement, but now it's coming back down to weakness, and we're back down to this, at least with this ratio, we're down to the 200-day moving average. Here's our ADX showing our trend where it's trying to turn up. We're not quite across the moving average yet. The green line's on top, but is declining. The red line's on the bottom, and that's advancing. So overall, we're still in a trendless environment. And here's the BPI, just because I've been focusing on that a lot lately. Not a real big change here. On the positive side, you could say, okay, this is holding up, even though we had a decline. On the negative side, you can see where we spiked up recently, and look at what happened other times when the BPI spiked up. The S&P really declined after that. Is something like that going to happen this time? It's still undecided at this point. Here's our double and triple exponential moving averages. The blue double moving average had been providing support. We broke above that. Now the triple was providing support. Well, we broke down below that, but we're still above the double exponential moving average. Here's our daily chart where we, a couple days ago, had come right up to the trend line, could not break through that, came back down. This was Tuesday's session. And then here's Wednesday, where we're showing the decline overall. We're still right a little bit below the 200-day moving average. And in yesterday's video, I erroneously said that this is the 50-period moving average, and I posted a little note on the video for that. We did get above the 200-day moving average, but we didn't stay above that. We closed down below it, so that's more negative. We're still above the 50-period moving average, so that's more positive. And then if you look down at the bottom, we have seen a little pickup in volume with our above average being slightly above the moving average here. Here's our moving average tree, where we had been right at the 200-day exponential moving average. Well, we're coming down, and the shorter term moving averages, the 20s, they're kind of where we're at right now, with the exponential and simple moving average providing either support or resistance. And we're seeing a lot of these lines coming closer together, and that's just showing more of a sideways environment. Now, that could end at any time, so we're never quite sure how long this will last, but we've been really going sideways since the early to mid part of November. New highs, new lows, saw a little bit of a contraction, but an increase in the new lows, in the new highs. No real increase in the new lows. So these two lines are pretty much right on top of each other right now, and we're pretty much flat to slightly increasing with our 10-day differential. This is a chart I haven't shown in a little while. Sometimes this chart is a leading chart for us, where the Swindlin trading oscillator, based on price and volume, it's continuing to advance, and they're both above zero. So that could be positive. The problem with this is we don't really know ahead of time if this is a legitimate signal or a false signal, but we just kind of want to be aware of this. Anyway, this is still more positive. Also, a little bit more positive is the SAR. We had the first dot drawn underneath after yesterday's session. Well, we had another line or dot drawn under the bar chart for Wednesday's session. Okay, let me back that up now. We had a dot for Tuesday's session underneath, and then for Wednesday's session, another dot. How's that going? We're kind of dropping below this 61.8% retracement now. We closed just below that. We're kind of in no man's land overall. We're just bumping around as we're going sideways overall. And longer term, we still continue to be more or less in no man's land in between these support or resistance levels. One thing that is positive, we're seeing the Dow give us a golden cross. The 50-period moving average is crossing above the 200. That is positive. And this is what a lot of folks use as a signal. We're not seeing that in the S&P yet. We're kind of a long ways away from that. We're not seeing it in the NASDAQ or the NASDAQ 100. But especially through the fall, the Dow has been the chart and the index that has held up the best. But that's only 30 stocks, where the S&P is over 500 stocks that we follow. But this is just something to be aware of. And I teach a system like this in my course, where it's just a moving average crossover system. When this moving average crosses above, you go long. When it goes below, you either get out or go short. Well, right about now, if you're in a Dow-based system and using these indicators to make your decisions, you would be looking to go long right now. So that's more positive. So what's our outlook then for Thursday? Technicals are negative, but we think they might be improving. They were looking a lot better before Wednesday's session. We have the retail sales. That's probably the biggest report that's coming out in Thursday's session. We have jobless claims, which come out every week. The Philadelphia Fed survey, which is confined more to a region, as well as the Empire State Manufacturing. That's more in New York. Industrial production and capacity utilization. That can be significant as well. And then business inventory. So we're getting a lot of data in Thursday's session. And then the whole list of geopolitical events. But as far as the stock market is concerned, they're fixated on this inflation interest rate scenario. But any one of these things that you see here could come back to the forefront at any given time. So our scenarios can't really go with the down scenario because we're not really trending. And we don't really know if things are improving. They possibly are, but it doesn't really look that way. Can't really go with the up scenario for the same basic reasons. So we're going with the sideways for right now, where the ADX is getting a little bit stronger. It's trying to get above the moving average. We're still below 20, and it is positive. In our conclusion, the S&P is negative and maybe getting better. Short term, maybe better, but still negative. Intermediate term, negative, maybe getting better. Long term, we're still negative because we closed below the 200-day simple moving average, even though we were above it for a period of time in Wednesday's session. Thank you very much. Hope you have a really good Thursday. We'll try to sort things out and make them a little bit more clear, just day by day. That's what we try to do, but it's pretty foggy right now. So good time for maybe doing sideways strategies or trendless strategies. If you're familiar with those, I do teach those in my class. So you might look at something like that for the time being. So have a great day, and I'll talk to you in the next video.